Picture this. The year is 1800. A private company has a standing army of 250,000 soldiers, twice the size of the British military. It prints its own currency. It rules 200 million people. Half of all world trade passes through its hands. This wasn't a country. This was a publicly traded corporation, listed in London, owned by shareholders. It disappeared after 274 years. How does a small group of merchants build the most powerful empire in human history, and who actually paid for it? Welcome back to Strategies and Legends. Today, we're not telling the story of a man. We're telling the story of a machine called the Honorable East India Company, chartered December 31st, 1600 by Queen Elizabeth I, dissolved June 1st, 1874. 274 years, wars, famines, speculation bubbles, and opium trafficking on a scale that would make a modern cartel look like a corner store. This isn't a biography. It's a strategic and economic autopsy. And we're going to look at it through a lens most historians skip: vertical integration, too big to fail, regulatory capture, crony capitalism. The East India Company wasn't ahead of its time. It was our time, 3 centuries early. December 1600, London. A group of 218 merchants gather in the city. Their plan? Break the Dutch and Portuguese grip on the Asian spice trade. In 1600, spices were the oil of the 17th century. A pound of nutmeg could be worth more than its weight in gold. But a single voyage to Asia cost a fortune. Ships, crew, weapons, 2 years of sailing, and a very real chance of losing everything. No single merchant could carry that risk. So they invented something new: the joint stock company. Instead of one rich guy gambling everything, you sell shares. Hundreds of investors pool their money. They share the risk, they share the profit. Today we call that an IPO. Back then, they called it survival. The founders had stumbled onto a principle most of the world wouldn't grasp for another 200 years. Risk isn't your enemy. Risk is an asset, as long as you can distribute it. Here's the part no one puts in the brochure. For the first 150 years, the company was kind of a failure. 1623, the Amboina Massacre. The Dutch, who had their own bigger, meaner version of this corporation, round up 10 English merchants and execute them. Get out of our spice islands. The English are pushed out of Indonesia entirely, so they fall back on the consolation prize: India. Considered second tier at the time, the real money was in cloves and nutmeg, and the Dutch owned that game. For 150 years, the company is mediocre, profitable some years, bleeding cash others, always on the edge. And then comes 1757. June 23, 1757. The plain of Plassey, Bengal. Robert Clive, 32 years old, a former bookkeeper turned soldier, faces the army of the Nawab of Bengal, 50,000 men, French cannons, war elephants. On Clive's side, 3,000 soldiers. On paper, this should be a massacre. In reality, it's already over, because Clive did something that has nothing to do with battlefield tactics. He bribed the enemy commander Mir Jafar by promising him the throne. At the critical moment, Mir Jafar simply doesn't fight. Plassey isn't a battle. Plassey is a hostile takeover. And this is where the company has its great economic revelation. Until now, the model was buy stuff in India, sell it in England, earn a margin, risky, competitive. But after Plassey, they figure out something far more powerful. If you control the territory that produces the goods, you don't have to buy them. You take them as tax. Immediate result? 800,000 pounds of silver shipped straight to Fort William. Years of trading profits, wiped out in a single afternoon. Today, we'd call this extreme vertical integration. But Clive went further than Amazon or Apple ever dreamed of. He integrated the state itself. October 22, 1764, the Battle of Buxar. 7,000 company soldiers crush a coalition of nearly 40,000. And listen to who is in that coalition. Mir Qasim, the deposed Nawab of Bengal. Shuja-ud-Dawla, the Nawab of Awadh. And Shah Alam II, the Mughal emperor himself, heir of Akbar, personally on the battlefield. A merchant company from London just defeated the Mughal Empire in open battle. Why? A fragmented coalition never beats an aligned organization. Consequence: August 12, 1765. Shah Alam II grants the company the Diwani over Bengal, Bihar, and Orissa. In plain English, the right to tax 25 million people. The company is no longer a trading firm. It's a private tax state, the economic engine of empire. The company now stands on 3 pillars. Pillar 1, land tax. Bengali peasants pay up to 50% of their harvest. Pillar 2, state monopolies. Salt, saltpeter, opium. Set the buying price low, set the selling price high, pocket everything in between. Pillar 3, the dark genius, the China trade triangle. The British are addicted to Chinese tea. The Chinese want nothing the British make. Solution? Grow opium in Bengal, smuggle it into China, get paid in silver, use that silver to buy tea. By the 19th century, opium represents on average 14.5% of the company's total revenue. Today we'd call this a state-sponsored narcotics cartel. Back then they called it free trade. The whole system creates a self-reinforcing loop. Taxes fund the army that conquers more land, that generates more tax. In modern business, we call this a flywheel. Amazon dreams about it. Apple lives by it. The East India Company invented it in the 18th century. Machines that get too optimized, they break. First crisis, the Bengal famine, 1770, bad monsoons. Harvests fail. Any rational government would lower taxes and import food. But the company isn't a government, it's a corporation. So instead of lowering taxes, they raise them, because the directors in London are waiting for their dividends. The result? Roughly 10 million people die, nearly 1/3 of Bengal's population. This is extraction without sustainability. When you optimize short-term cash flow without reinvesting in your productive base, you kill the goose that lays the golden eggs. Second crisis, the 1772 bailout. By 1772, the company is staring at bankruptcy. They ask the British government for an emergency loan of about £1 million. Put that in perspective. £1 million in 1772 equals roughly £237 million today, about $320 million. In relative economic weight to British wealth at the time, tens of billions of dollars in today's terms. Sound familiar? AIG in 2008. Lehman Brothers, the one we didn't save. Credit Suisse in 2023. Same mechanism, 250 years apart. The company has become too big to fail. The government bails it out. And in exchange, Parliament passes the Regulating Act of 1773. What looks like regulation is actually regulatory capture. Crony capitalism has just been born. Third crisis, the Tea Act and the Birth of America, 1773. To help the company unload unsold tea, Parliament gives it a monopoly on the American market. The colonists dump it into Boston Harbor. Direct consequence? The American Revolution. Let that sink in. A private corporation, through its lobbying, just triggered the birth of the United States. 3 lessons from this autopsy. Think about how they apply today. Lesson 1. Structure beats genius. The East India Company wasn't founded by a visionary. No Steve Jobs, no Napoleon, just 218 ordinary merchants with one brilliant idea. Pool the risk through joint stock structure. That structural innovation allowed mediocre individuals to collectively build the most powerful company in history. Structure beats talent, every time. Lesson 2. War is also a profit and loss statement. Every conquest of the company was planned like a business case. Cost, risk, return on investment. Plassey, £800,000 in silver. Immediate ROI on the bribes paid to Mir Jafar. Buxar, acquisition of the Diwani. A perpetual dividend on 25 million captive taxpayers. The First Opium War. Military cost absorbed by the British Crown. Commercial gains captured by company shareholders. Privatize the gains. Socialize the costs. Recognize the pattern? What we today call crony capitalism is not new corruption. It's the original model of modern capitalism. Lesson 3. Every extractive empire destroys itself. The most important lesson, the one that should keep every CEO awake at night. The East India Company wasn't destroyed by its enemies, it was destroyed by its own model. By extracting without reinvesting, it impoverished its own productive base. By 1857, the Indian sepoys, who made up most of its army, revolted. The Indian Rebellion of 1857. Extraction generated its own destruction. The end plays out in two acts. 1858, the nationalization. The Government of India Act strips the company of all political and military power. The Crown takes direct possession of India. This is the start of the British Raj. But the company itself survives, hollowed out, for 16 more years. Why? Because the shareholders have to be paid off. And those dividends come straight out of Indian tax revenue. The Indian taxpayer literally finances the exit of the British shareholders. 1874, the legal dissolution. Last coupon paid by its victims. Modern application, call it the extractor's dilemma. Any organization that optimizes short-term flows at the expense of its productive base, employees, suppliers, customers, ecosystem, eventually triggers a revolt that destroys its own model, always. The company understood, better than any government of its day, that without cash flow no army marches for long. But it forgot, until it was too late, that without legitimacy no cash flow lasts forever. It invented the multinational, the IPO, the corporate lobby, too big to fail bailouts, regulatory capture, crony capitalism, economic warfare, everything we accuse big tech of today, everything we blame on systemic banks. The East India Company invented it, tested it, and blew itself up with it. 3 centuries before us. We don't live in a new world. We live in a world where the same economic mechanisms keep replaying in different costumes for the last 400 years. The question isn't whether history repeats itself. The question is, which of us this time around actually learns from it? Which modern company comes closest to being the new East India Company? Apple, Amazon, BlackRock, Saudi Aramco, ByteDance. And have we actually learned anything in 400 years? Or are we just running the same script with better PR? Comments below. Like the video if this moved you. Subscribe so you don't miss the next strategic autopsy. And share this with that one friend who thinks capitalism was invented last Tuesday. See you next time on Strategies and Legends.